Hello, everybody, and welcome. Today we're going to go through and talk about adjusting entries for unearned revenue slash consulting services revenue. This presentation is copyright the accounting professor or accounting professor. My name is Bennett Tchaikovsky. All rights are reserved. If you'd like to use it, please contact me before doing so. Opinions expressed herein are those of myself and do not represent those of Irvine Valley College or the South Orange County Community College District. So let's go ahead and get to it. So as we look over here for this question, again, we've got over here on 5/1/24, we receive $80,000 from a client. We will perform the work at a rate of $20,000 per month beginning on 5/1/24. Now, this is effectively what we would call at 5/1/24 because we've received cash but have not performed any of the services yet. This is what we would be going through and basically calling unearned revenue. And if you look at the examples that I provided, going back to the very basic stuff, the way I would write it, cash was received from a customer during 2025, but the services would not be performed until a later period or 2026 or after the end of the year. And so what I wanted you to do initially was just how do we go through and record this type of transaction? And so let's just go do the basics. So for a typical unearned revenue type of transaction, right over here, I received $80,000 from a client. Okay. I will perform the work at a rate of $20,000 per month beginning on 5/1/24. So I'm going to debit cash for 80,000 on 5/1/24. And for every debit, I need a credit. Now, the key thing here is I've received money, right? I haven't done any of the work yet. So what I need to go through and do is call this unearned revenue. This is not revenue. This is a liability, meaning that I've received money, but I have not yet done the work. Okay, very important concept in terms of between the differences between revenue and unearned revenue. If I look at our friends at Tesla, I don't own a Tesla, but if I look over here at their balance sheet, you're basically going to see something over here. Under their liabilities called deferred revenue. What could that be? Well, when you buy a Tesla, what I've heard is you can buy like software upgrades. If they haven't released the upgrades yet, it's deferred revenue because they haven't yet released the upgrade. So they've got the money, but they have not yet performed the service. So it is going to be unearned revenue. Now, so we come over here, prepare the entry to record the transaction. I received cash. Cash is an asset. I'm going to show that increase with a debit. For every debit, I need a credit. Well, it's a liability because I have not yet done the work. So I'm going to show that over here with a credit. Now, assume that LGA worked for the client through 12/31/24 and did not further invoice or receive any additional funds from the client. Prepare the adjusting entry using T accounts on 12/31/24. So let's talk about this. When it comes to preparing adjusting journal entries, we have to be able to say the following items. Do our revenues reflect what we have earned? Do our expenses reflect what we have used? Do our assets reflect their future economic benefit? And do our liabilities reflect our future obligations? We never adjust for cash. So when we see this type of question, right, the way I would kind of approach this is I would say, well, how much revenue should we recognize for 2024. And the reason why I'm saying it like this is because, well, when we do adjusting entries, do our revenues reflect what we have earned? So over here, if I look at consulting services revenue, my question is, well, I started working on 5/1/24 and this ended 12/31/24. How many months is that? May, June, July, August, September, October, November, December, a total of 8 months. So I worked for 8 months. Whether or not I invoice the client does not matter. But what does matter is I need to go through and record revenue. So my monthly rate that I'm charging is $20,000 per month. So the amount of revenue that I need to recognize is going to be $160,000. So I need to record consulting services revenue of 160. Now, over here, how do I record revenue? I'm going to record revenue with a credit. Now, I've got kind of an interesting thing going on here because I've recorded this revenue, but I only got 80 grand worth of cash. So really, what does this client owe me? Well, if I did 160,000 of services and the client paid me 80 grand, then that client really owes me another $80,000. So how do I go about kind of figuring this out? Well, when I look at this account, our revenues need to reflect what we've earned. Our liabilities need to reflect our future obligations. Now, at 12/31/24, should we have any unearned revenue? Or have we earned the revenue? And the answer is we've earned it. This was a 4-month advance, right? Basically 80,000 divided by 20 is 4 months. So we got a 4-month advance. So we did this work. So basically, when I'm crediting this amount at 12/31/24, my adjustment is 160 credit. For every credit, I need to have a corresponding amount of debits. So what I'm going to do here is, well, I've earned this unearned revenue. So I'm going to debit unearned revenue for $80,000, right? So again, this account now goes to 0. Now, when I look at this, I need to balance this equation. I need another debit of $80,000. Now, for this one right over here, I performed 160,000 worth of services. I was paid cash of 80. I am owed the difference, or $80,000. So this is going to be a debit to accounts receivable. Okay. So if you're given a situation where the unearned revenue cannot fully cover the consulting services revenue, like in this case, we need to zero out this balance and then put the rest to accounts receivable. Now let's just kind of talk about this real quick. So when I go through and look at this particular question, I have to ask myself the following questions, right? First off, I never touch cash. Do my revenues reflect what I've earned? And that's really where you want to start with these kinds of questions. It's 20,000 a month. I worked for the client through 12/31/24. So the total amount of revenue I should be recognizing is going to be $160,000. Now, I've got a credit of 160, but I can't just debit accounts receivable for 160 because the client doesn't owe me that much. Because what I first have to do is to exhaust this unearned revenue. I need to make this account go to zero. So I'm going to go ahead and debit unearned revenue for whatever the amount is to make it go to zero. And then the excess is going to go to accounts receivable. So can I answer my questions? I have no further liability in the form of services I need to perform for this client because I've exhausted through that work. So my liabilities do reflect my future obligations of zero. And my assets, this now reflects what I am owed, right? This client, I did 160,000 worth of work, less the 80 they paid me. They owe me $80,000. Okay. So these revenue questions can get tricky. What I would really kind of advise you to go through and do as you're going through and doing them is to start with the amount of revenue to make sure that that's correct, and then look at the ancillary accounts, which are really going to be unearned revenue and accounts receivable. So thank you for joining me here today. Look forward to seeing you on the next video, and have a great one.